Good afternoon, everyone. Thank you so much for joining us today. I know it was very hard to tear yourself away from the England-Denmark game, but we promise that we'll have the results later for you today. I am actually very pleased today to be joined by three esteemed gentlemen. I'll start introducing them from my closest to my right. We have Mr. Julian Robinson, who is the opposition spokesman in finance. Next to him is Mr. Charles Ross, who is the CEO and president of Sterling Asset Management. And we also are joined by Dr. Wayne Robinson, who is the senior deputy governor at the Bank of Jamaica. And we're very grateful for you guys being here today. Thanks for joining us.
Thank you. Thank you.
Now, today we're going to be discussing some of the most important economic issues facing Jamaica. And our theme actually focuses on charting a course to recovery for Jamaican investors in the new global landscape. We'll be trying to find out what our economy will look like post-COVID-19, what will be the drivers, and where can Jamaican investors and business people look for opportunities. Now, we'll be starting with some housekeeping items. I'll be grilling these gentlemen for about 30 minutes, and then we'll be inviting the audience to ask them some questions for another 15 minutes. Please type your questions in the chat. Even throughout the event, we'll catch up on them later. So thank you for joining us again, and we'll get right into it. Now, I'll start with a bit of an icebreaker question for you all. And maybe you can start by telling me, what do you think the best decision that the government has made since the onset of COVID? And perhaps, Julian, we can start with you. Yes.
And I'd probably say there are no good decisions made.
Right. Yeah.
But what I would say is that the government followed through on the institutional reforms in relation to establishing an independent central bank. And I think that was important because while the work would have started prior to COVID and would have been in the platform for a very long time, given all the competing priorities, I think sticking to the course to ensure that we have an independent central bank, for me, was an important economic decision and sets the basis for all the other reforms which I believe the economy needs. So that, for me, was an important one.
That's a very good point. I can't disagree with you there. Charles, what, in your opinion, was one of the best decisions?
Well, it really was an unprecedented challenge. And I think the effort to try and put money into people's pockets was a commendable effort. Given our fiscal reality, I guess there wasn't a great deal of space there, but I think it was a commendable effort to try and put money into the hands of people who otherwise would have seen their livelihoods impacted very negatively by the pandemic.
Okay, great. And Dr. Robinson?
Well, I agree with what was said before, and I'll just follow on that. And when you think about it, I'd perhaps say the key decisions actually occurred before the crisis. And these were the reforms, both the fiscal reforms and the monetary policy reforms, one of which Julian spoke about, that the government took, such that when we entered the crisis, the government had fiscal buffers that allowed it to do some of the things that Charles speaking about. Also, the central bank had health reserves, and we had an environment of relatively low inflation. So that gave us a lot of room to be able to respond and to ensure that there is sufficient liquidity in the financial system, and such that we can maintain some semblance of stability.
That's a very good point. So a lot of the work preparation was done before that allowed us to survive. Now, I guess the converse question, and Julian, maybe you'll like this question better. Are there any areas that you think the government could have done better with the resources they had, or managed a challenge differently?
I think in the area of vaccines, I think we started off late, and in fact, I think we have, if not the lowest vaccination rate in the Caribbean, maybe the second to lowest. Wow. We're somewhere in the region of about 5 or 6%. All the other countries are much higher than us, which will have a direct impact on our ability to reopen the economy. We have taken steps to ease some of the restrictions, but obviously with such low vaccination rates, the risk of a third wave is very real, which may then bring back more restrictions. And if you have restrictions, you may have contraction in the economy. So that, to me, is something that I believe could have been managed more proactively and better. On the specifically on the economic side, I think logistically getting the transfers to 400,000 people in a short period of time was good. Right. But in terms of the quantum of money that we provided, the $10,000 one-off $10,000 payment, relatively low from my perspective for people who may be out of an income for 12 to 15 months. And I believe there's more that can and should be done, particularly for those who are most vulnerable.
Right, so suspending some of the fiscal rules to enable us.
To enable us to do more. And I say that not just because I believe government should give away money, not at all. I also believe it will positively impact our recovery because it will stimulate demand and consumption, which I believe will generate economic activity, which in my view will push recovery quicker than having a longer, prolonged recovery.
Fair enough. Yeah. Charles, did you have anything to add to that?
Well, it's very difficult, really, to be overly critical. But perhaps for me, one of the things that I think we didn't do, we haven't done sufficiently, is allow the market mechanisms to provide more of a buffer. What we saw in many countries, developing countries and otherwise, were significant adjustments in their exchange rate, which would have dampened imports, increased local demand for production, and would also help the country to absorb the shock without having to borrow additional resources. Wayne spoke about the adequacy of our reserves. They could have been used perhaps to dampen things or to absorb that shock. But, I mean, that's really, I guess, taking a fairly fine point on it. Mm-hmm. But I do think that one of the things that we need to do in Jamaica is allow market mechanisms to absorb some of these shocks, because they really are, totally unprecedented. Mm-hmm. And there's a limit to how much of the reserves you're willing to sacrifice in that cause. Mm-hmm. So allowing more flexibility in the exchange rate is one way of compensating for that.
Sounds like a political topic there, Charles. A politically difficult decision there, but
independent central bank.
But yes, I know.
I definitely would have to take Charles on that. I mean, look, we agree in principle what Charles is saying, in that when you have a flexible exchange rate, that is what the exchange rate is supposed to do, absorb the shock. But what I'll say to Charles is that that's what actually happened. I mean, the exchange rate for last year moved between 7 and 8%. During the year, it moved by even much more than that. And so we think a part of the reason why the economy has shown the sort of resilience and we've not had the degree of fallout is because we have allowed the exchange rate to adjust. But we also have to be mindful that we have a very thin market. It's a thin developing market. So you have to manage those adjustments. You can't just let the adjustments run. And so we have tried to very judiciously use our reserves at important points in time to manage that. Wherever we saw where the market was becoming destabilized, where there could be a potential destabilizing movement, I mean, we'd step in just to ensure that the market behaved in an orderly fashion without trying to obstruct any movement in the underlying exchange rate. And I think we have successfully done so. The real exchange rate has depreciated. We have maintained competitiveness, and we didn't see a fallout in our reserves. We actually continued to maintain very, very healthy reserves.
Yeah. But can I take Charles on a point you made? Do you think if we obviously have a managed system, and Wayne is using coded language, yes, right, in terms of the BOJ's intervention. But the point I would take you on is, do you think if we allow the currency to depreciate, that it would in fact lead to a reduction in imports and an increase in our competitiveness with exports, given our very high import dependency as an economy?
Absolutely. In fact, I think one is a product of the other. In other words, we are very highly import dependent, because, as Brian Winter put it very diplomatically, a central part of policy for a very long time has been maintaining what he called a subsidized exchange rate. So in other words, a great deal of resources and effort has been put into restraining depreciation of the currency for various reasons, but so that we haven't really been able to get the benefit of a floating exchange rate. If you look at somewhere like Brazil, their currency fell by something like 40% initially. Even though it's recovered somewhat, it's still maybe down 25, 30% on where it was pre-pandemic. But that's just the market, and you know, I mean, they have hundreds of billions of dollars of reserves, but they're prepared to let the exchange rate be market determined, and there's a shock, and the exchange rate adjusts and absorbs and whatever, and they move on. I mean, they're not, you know, the central bank isn't out there intervening and trying to manage the rate.
In fact, they're increasing interest rates.
We have other problems.
But I really wish I could convince Charles otherwise that we have a flexible exchange rate by all measures.
Two opposing views here.
We allow the exchange rate to reflect market fundamentals.
Yes.
Would we dispute Julian's point that we have a managed exchange rate?
It's managed.
Well,
I don't think you can dispute that. That's managed. And I don't have an issue with it being managed, you know. So I'm not being critical. But it is managed.
Yeah, but you have to clarify that, though, because our management is to ensure that the market functions efficiently.
Yeah.
Our management is to ensure that you don't when you have a movement, it doesn't lead to any destabilization of the entire system. So you because it's a small and thin market, you have to be mindful of those things, whilst at the same time allowing the exchange rate to move according to market conditions.
Well, as a follow-up question, may I ask? This is a bit off topic, but is that a concern? Is your concern about? Is there a risk that the concern around a destabilization? What is the probability of that, or is that a real? You know, do you think that too much emphasis is being placed on that concern? For instance, the risk of a destabilization from the currency moving too much, say, for instance.
I think if you ask, well, Wayne can answer. Your primary objective as a central bank is what? Inflation targeting.
Precisely.
So that is why they can't allow it to run the way that without intervention.
No, but I disagree fundamentally on that. What has happened to inflation in Brazil as a result of the movement of their currencies? No change. It's the other way around. In fact, it's inflation that drives movement in the currency, not vice versa. Yeah.
So we have
in reality, in our scenario.
Yes.
Well, in
Just
economic
like
theory.
In economic theory.
Just like anywhere else.
Yeah.
The laws of economics apply in Jamaica.
Well, there are some nuances, but let me state. I mean, we do not target the exchange rate. We do not target any particular level of the exchange rate. As Julian said, we target inflation. Now, exchange rate is one of the factors, of course, that will affect inflation. And the good thing is that when we look over the past 10 years, the impact of exchange rate movement on inflation, that has been coming down. So that has been very encouraging. But our objective is to ensure that the market works and that the exchange rate reflects market fundamentals, but it has to be in some orderly manner.
Okay, so we have
chaos doesn't help.
Yes, okay. So we have the philosophies, different though they may be sometimes, but I think that's a constructive, a very constructive and interesting dialogue. Charles, do you have something? Last thing to add, or can I move on to my next question?
Yes,
anyone?
yes,
Okay, great.
move on.
Yeah. So I guess this is somewhat related, actually. If each person could tell me their top two conditions that you think must exist for macroeconomic conditions that must exist for economic growth to take place? And we ask this in the context of the fact that sometimes we get very lengthy policy recommendations or just general recommendations from multilaterals, whether it's the IMF or working groups, the World Bank. They'll say, oh, of course, you can get 5% growth if you do these 1,000 things correctly. What would be your top two that you think of conditions that are necessary for growth to come about? Julian, we can start.
I think you have to address the issues in our labor market. Or when you look at our productivity has declined consistently over a long period of time. We are by and large attracting investment that deals with relatively low-skilled, low-level labor, whether it is in, and I'm not critical of these sectors because they provide jobs, whether it is in BPO, whether it's in tourism, right? And that can keep you at 1% and 2% growth. But if you want the 5 or the 6, you have to transition to higher skilled type industries. And there are many opportunities in knowledge process outsourcing, moving up the value chain, but you're not going to get the investment unless you have the skilled personnel in the country that an investor would be attracted to. So I believe that is something that has to be addressed. And I think price stability is important in terms of ensuring that we have economic growth for a number of reasons. We had a long debate about inflation and the correlation with exchange rates, but I think price stability is critical for your labor markets, for consumers who are going to drive demand, and also for producers too. So if you ask me the two, I would pick those two as two important ones for criterion for economic growth.
Okay, great. Thank you. And Dr. Robinson, I know Julian referenced price stability, so I figured it would be appropriate to,
yes,
to go to you
and, you know,
next.
he's correct.
Yeah.
I mean, fundamentally, you need a stable macroeconomic environment where there's predictability in inflation, where there's predictability in interest rates.
Yes.
So you really need sound monetary, fiscal policies. I mean, if you really think about Jamaica's growth challenge, and you know, Julian touched on it, I mean, our low growth really reflects low productivity. We have low productivity because we have inadequate capital, and also we have inadequate human and social capital. So there is a need to drive private investment in the high value-added sectors, and I want to stress that along the line of what Julian was saying, because our investment to GDP, it's about 19%. DOMREP is about 21. Other countries would be about 20, 25. I mean, so we're not so bad there, but the question is where the investments are contained. And we want to see more investments in these high value-added sectors. So if you want to drive private investment, you need a predictable economic climate. If you want to drive investment in human social capital, you need fiscal space. And therefore, you have to bring down the debt. I mean, government interest payments as a proportion of revenues is about 23%. So a little bit over a fifth of tax revenues still goes towards interest payment. That's a huge chunk. So you have to bring down the debt and the debt servicing costs to create the space for these sort of investments in your human and social infrastructure that you need. So fundamentally, you need sound fiscal and monetary policies.
Right, that's an excellent point. Charles, would you?
Well, I think we need an export-led growth strategy. And I absolutely agree with Wayne that part of the move to create fiscal space has to be a containment of our debt. And a part of that effort has to be to maintain a sustainable current account, external account. A big source of debt creation in Jamaica in the last maybe 20, 30 years has been financing and covering that current account deficit. The multilaterals put a lot of emphasis on the fiscal deficit, but that's just actually a part of what has been driving Jamaica's debt over a long period of time. And that is correlated or related to the issue of the exchange rate and how that's determined and so on. But basically, I'm a firm advocate and believer in an export-led development strategy. And I think macroeconomic policy has a huge role to play, because the bottom line is that we're not going to change the education level of the Jamaican population overnight. And we can't just say, well, we're going to allow hundreds of thousands of people to remain unemployed or underemployed. We need to allow their labor to be competitive, internationally competitive, in whatever activities can absorb them domestically. So I think that macro policy has a huge role to play. And I think Wayne is absolutely right that macro stability is important, but it must be sustainable, both internally and externally. And if we can achieve that, then I think we can create the conditions that will allow for export-led growth.
Okay, great. And do you, sorry, Julian?
I was going to say, Charles's thesis is allow the currency to find its true value.
Exactly.
And
Going
our
back
exports
again
will increase.
to the consensus. And well, subsequent to your comment, Julian, do you think there is an alternative economic model?
No. I'm firmly of the view, as a small island developing state, that export-led growth is the way, and it's primarily going to be dominated by services. I still think there are opportunities in goods, because one, you have a diaspora, but you also have, beyond the Jamaican diaspora, there's a market that I believe you can target, and I think there are private sector companies that are innovating with their products and ensuring they get it out there. But I don't think we have a choice as a small island developing state but to pursue an export-led growth strategy. And I think there's a lot more room. I'm not with Charles fully on allowing the currency to find its value. And I tell you, because I'm not sold on the view that that by itself will drive the exports without more. Given our very low productivity rates, the relatively high levels of investments that we have had, but our very low productivity rates. So, but yes, I would agree with the overall approach that it has to be export-led.
Thank you for pointing out where you disagree. Dr. Robinson, would you have something to add? You looked like you had something to add.
I agree. If you think about it, Jamaica's per capita income is about 5,300 US. Now, as a country, our goal must be to double that in the next 20 or so years. Now, you can't do that by just focusing on the domestic economy. You have to focus on broader, bigger markets that are closer to you. And when we talk about export-led growth, we're not just talking about exporting more tourism or exporting more bauxite. We're talking about having a more diversified export base, more diversified products, and more diversified markets. I mean, it's not a coincidence that most of the studies now shows that countries with a more diversified set of markets, export markets, and countries with a diversified export base tend to do better and tend to be more resilient in crisis. The other thing I would add to the discussion is that what's important is not just the nominal exchange rate, but the real exchange rate. And the real exchange rate has to be competitive if you're going to be a successful exporter. And that's particularly important if you have an economy has very low productivity. Something has to compensate in terms of having the exchange rate in real terms being at a competitive level. And that is what we have sought to achieve over the past couple of years in terms of the economic program, where we have allowed the exchange rate to adjust. I mean, our view now is that we think it is fairly valued now. So we're not that much concerned. We think we can allow the exchange rate to reflect market fundamentals. But what's important is that in real terms, not just the nominal exchange rate movement, but in real terms, it is competitive.
Yes. 100%.
And how do you determine that competitiveness? No, I mean it seriously, because
I'll give
you obviously
Julian a share of my
intervene.
moderator fee.
Sorry.
No. Please don't apologize.
No,
It's good.
because
That's a good
you
question.
intervene, and again, I don't have an issue with managed intervention, but how do you determine when you should? Is it the level of volatility within a specific period of time? What are the factors that determine that?
Very good question. And I'm happy for this opportunity. I mean,
Very good question.
we look at how the market is performing. What are the market conditions? Are you having too excessive volatility that can create distortions? Are you having a situation where because of excessive volatility, what is happening is that flows, just because of that, not because of anything fundamental, just because of that, those flows are drying up. So that the market itself is beginning not to function as it ought to. When we see those conditions, we will step in. Our role is to ensure that there is liquidity and that the market can function and that the exchange rate reflects market fundamentals. When you have a very small, thin market like what we have in Jamaica,
Dominated by 2 or 3 dominant players?
You have to pay a lot of attention on how the market is operating. At a broader macro level, I mean, we have to assess, as I mentioned, where the real exchange rate is. We have to assess, and there are a lot of metrics that we look at. I mean, we look at what is happening in the balance of payments, in the current account. That gives a very good signal as to whether or not your exchange rate is appropriate. And over the last couple of years, the balance of payments, the current account deficit has been pretty low. Over the last 2 years, below 1%. In fact, we think that for last fiscal year, we may end up even with a balanced current account. So the current account deficit has been very, very, very low. So we both look at the broader macro fundamentals. We look at where the real exchange rate is, so as to see whether or not we are losing or gaining competitiveness. And then we also look at how the market itself is operating. And then that guides when and how much we will go in.
Right. Excellent point, and thank you for the question.
No,
please ask them. It was a great question. I couldn't have followed it up better myself. And actually, maybe on that topic, Dr. Robinson, we've seen in the US, for instance, a spike in inflation. The Fed there suspects it's transitory. But do you think that the impact of that, the rise in US inflation will have an impact on the Jamaican economy, or, you know, is that something that people should care about?
Well, the rise in inflation that you're seeing in the U.S., I mean, inflation there rose to about 5% in May, the highest in about 13 years. That is a global phenomenon. And what's behind it? A number of factors are behind it. Primarily what I call a snapback in economic activity. There's been a rebound in economic activity and a rebound in confidence as economies reopen. On top of that, there has been significant monetary and fiscal stimulus in these economies. And so demand is bouncing back very quickly, well ahead of supply, well ahead of the ability of firms to respond, and also well ahead of the labor market to respond in the US. And we should also bear in mind that a number of the commodity prices, for example, fell to historic lows last year. So there are some base effects. So these are the dynamics that are happening. And they are having a spillover effect on the Jamaican economy. I mean, we're already seeing that. I mean, when we look at the producer price index that Statin produces, we see in terms of the prices that manufacturers have to charge on their products, we've seen that has gone up. For May, overall, it's about 13%. When we look at retail prices, that is, when we look at the consumer price index that Statin produces, I mean, as of May, inflation was about 5%. Which is bang on within our 4 to 6 target range. But when we look a little bit below that headline number, We're seeing where items related to cereals have gone up by about 7-8%. Meat has gone up between 9 and 10%. So we are seeing the effects playing out in terms of the Jamaican economy. So in that regard, whilst we think that inflation will probably still remain within the 4 to 6% band, we expect that it will move closer to the upper end of the band. And we think that there is some risk that inflation could even go above the 6%. The good news, though, is that we believe that these inflationary pressures will be temporary. As the supply bottlenecks work themselves out, as the supply chains, mend, prices, the rate of increase in the prices, they will moderate. The price levels may well remain high, but the pace of increase will moderate. And already we're beginning to see some moderation in some of the commodity prices. Soy, for example, wheat, corn, for example. Corn is a good leading indicator as well. We've seen that some nascent turns in those prices, so we're watching that. So that's encouraging. We're a bit concerned though, about the shipping costs.
Yes.
Shipping costs have gone up by over 300%. We think it's going to take some time for that market to adjust. But the bottom line is that we don't think that these inflationary pressures will be permanent. We think that they will be temporary.
Okay, well, that's definitely comforting. Charles, did you have something to add, Julian?
No,
I think Wayne can answer.
I thought that was very helpful. Yeah, and I mean, I guess just as maybe one last fire question for you, Dr. Robinson, the inflation range that you guys have of 4 to 6%. Can you expound on why you guys think this is the right range and how it was developed and the importance of it?
Look, we all want lower inflation, and over time, our goal is to be able to experience the sort of inflation that you see in the US and in our trading partners. But here's the challenge that we face at this time. And almost every economist who I know who have looked at it have come to the same conclusion that we have. If we're going to target, say, inflation of, say, 2%, that is, get inflation down to 2%, but more importantly, not just to get the inflation down to 2% today, but to keep it at 2% for the next 2, 3, 4 years, it would mean, certainly in the very short term, that the Bank of Jamaica would have to tighten monetary policy to get that to happen. What that means is that we have to raise interest rates. Now, there are consequences and implications for that. Borrowing cost in the economy is going to go up. The cost of credit is going to go up. That is going to affect economic activity. The slowdown in economic activity is going to affect government revenues. The higher borrowing costs could also affect government interest costs. I mean, significant proportion of their debt is still at variable rate debt. So the adjustment that is needed in terms of the fiscal accounts, the debt reduction that we spoke about earlier, that is required for the economy to continue to grow on a stable footing, all of that will have an impact. So the government had a choice. The government faced a trade-off. Low inflation now, but weaker growth and a weaker fiscal position now, or trying to accommodate a slightly higher inflation now, which would give the economy a little breathing room and give the fiscal a little breathing room to adjust. The government, we think, wisely chose the latter choice of the 4 to 6%. And we should bear in mind in Jamaica's historical context, 4 to 6% is still
very low for our history.
Yeah.
For sure. I think that was actually a great explanation, and I'm so glad you gave it, because there are, you do hear businessmen ask how this happens, and it's really important for us to understand the consequences of what lower inflation means. Charles?
Well, my only question would be, I mean, we've been in this range for some time. I mean, that's been the target range for some time, hasn't it? So,
since about 2017, 2018.
Okay. So 3-4 years. Is there any plan to, as to when we would make the transition to a lower rate?
Well, the target, which was just renewed by the minister in April, that is set for the next 3 years. I mean, we will review and provide the minister with advice. But this is one thing I say. If productivity in Jamaica turns around, if there's significant improvement in productivity, that will allow us to move towards a much lower inflation trajectory much quicker.
But that's not going to happen in the short term. I mean, we'd love it to happen, but the reality is that the factors that would drive improvement in our productivity are deep-seated ones which require a medium to long-term solution, particularly in the labor markets and trying to improve that productivity. So it's unlikely, while desirable, that you're going to have that in the short term.
Well, it's all about investment, ultimately. As Wayne pointed out, it's putting capital to work to make the labor more productive. And I don't know what are the factors that will drive that.
But I mean, I would say we haven't, obviously this year was an anomaly, but we haven't had a problem necessarily attracting capital in certain sectors. In fact, if you look at, if take tourism, if you take BPOs, as two growth areas, there's free-flowing capital. I mean, if you look locally, domestically at the construction market, capital is coming in, but it hasn't positively impacted productivity.
Well, I think you've put your finger on the problem. It is concentrated in certain areas.
It's the low-level areas.
And it's concentrated by and large in construction.
Sure, right,
so even the very productivity of that capital is very low. Yeah.
So the point I was making is I don't think more capital solves the problem without addressing the longer-term labor issues.
Well, my contention would be that if we were to get capital into areas that would boost the productivity of the labor, manufacturing, agro-processing, even agriculture itself, we could possibly see that increase in productivity. But in going into, I guess, what the economists call the non-tradables, I mean, tourism is a hugely capital-intensive investment, and there's very little that you can do to improve the productivity of the individual tourism worker. But if you were to invest, say, if we were to see an expansion in agro-processing or furniture manufacturing or some other type of industrial activity, it would the prospect of higher productivity would be there. Even the mining sector, which has a lot of capital deployed, and the workers in that industry are very productive. But it's a wasted resource. I don't think we can look to bauxite or alumina as the way forward. But
well, thank you for that, guys. That's great. I have a Q&A chat that is blowing up with lots of questions, of course. And of course, Dr. Robinson in the hot seat. I have a journalist asking you a very pointed question right away. And he has asked if, when you say inflation could overshoot the upper end of your 4 to 6% target, in true journalist fashion, by how much do you expect the target to be exceeded? Can you also look in your crystal ball and tell us for how long you expect the inflation target to be exceeded?
Okay, good question.
Yeah.
Our baseline projections still sees inflation being within the 4 to 6, more likely in the upper end.
Okay.
So when I mention about it going above, that is a risk we see. I mean, we're not able at this point to quantify precisely, but it is a risk that we do acknowledge. In terms of the longevity of the inflationary pressures, we think that it shouldn't go more beyond this year.
Okay.
Are you talking calendar or
Calendar year.
Okay, good.
We expect that certainly by the end of this year, I mean, we should see things. In fact, you should begin to see things moderating possibly by the second half of the year. Now, of course, the price levels are going to remain up there. But what we're talking about is the pace and rate at which it moves.
Of course.
Right. Now, I must stress there's still a lot of uncertainty. Yeah, as I said, there is a concern in the shipping market, for example, what would happen there. There's a concern in terms of the tightness of the labor market in the advanced economies and the implications that would have for wage pressures. So there are uncertainties and there are concerns. But at this point, we still think that, you know, our baseline projection has us still within the 4 to 6. And this is something we'll continue to monitor. And I mean, we'll advise our stakeholders in the public.
Right,
as things evolve.
Right, that's very helpful. And also a follow-on question to that is, when do you expect the economy to return to pre-COVID levels?
Okay. Our expectation is that we won't return to pre-COVID levels before 2023. And there seems to be a lot of agreement. I mean, you know, certainly with the Planning Institute as well shares this view. I mean, we are beginning to see nascent signs of recovery, however. When we look at GDP in the March quarter, that actually grew over the December quarter. It's by 0.6%, right? So it's still some growth. December over September, last year December 2020 over September 2020 also showed some growth of about 0.9%. So we are beginning to see some recovery. The signals coming out of the tourism sector is quite encouraging, quite positive in terms of the bookings, in terms of expected occupancy levels. So we feel confident that, I mean, there is some nascent recovery. We call it a Nike swish recovery.
Okay, yes.
But of course, I mean, there's still some amount of uncertainty. A lot depends on how we manage the COVID crisis locally. A lot depends on the rollout of the vaccination program. So there's still some risk. But by all indications, it seems as if the worst is behind us.
Okay, that's very good to know. Charles, a question, since you're the one that came up with this export-led growth strategy. Someone is asking, export-led growth in a highly import-dependent, low-skill, low-tech economy. Which sector would drive, or sectors would drive this strategy?
Well, the first thing I think is that, you know, we produce less in agricultural produce now than probably at any time in the last 50 years. And it's not because the island has shrunken and we don't have the land available. So that's one area. There's also a sort of vicious circle. Because we have maintained quote-unquote subsidized exchange rate for so long, we've created a demand for imports and we've created a disincentive for exports. If we turn that around, then we change the equation. We disincentivize imports and we incentivize exports. I'm a firm believer in the market economy and in market forces. So I don't think we have to sit and wonder. Businessmen are in the business of making money. And if the opportunities are in export, that's where people will go. If they're in manufacturing, if they're in agriculture, BPOs, tourism, whatever it is, money will go where the opportunities lie. So I don't think we have to ponder as to, you know, is it going to be tomato ketchup or hot pepper sauce? Is it going to be oranges or pineapples? I don't, you know, furniture or some other widgets. I don't think we have to puzzle about that at the moment. What I think we have to do is create the macro environment that incentivizes export production.
Okay. All right. And I have another question, and think this is relating to regional conglomerates who have found their way to the Jamaican equity and debt markets in recent years. And someone is inquiring, why has Jamaica emerged as the implicit leader of the regional capital markets? And are there any benefits, or what are the pros and cons of this, essentially? And I guess that could be a question for the panel. Dr. Robinson, I don't know if you have any strong opinions on more of a JSE securities dealer type issue.
Okay. In terms of why this has happened, a couple of reasons. First of all, Jamaica has had an open economy, certainly compared to our regional peers. I mean, capital can freely flow in and out. That's number one. Two, because of the economic reforms that we've undertaken over the years, Jamaica is being seen more and more as a less riskier prospects than before. And we see that in our bond spreads. We see that in our equity market. The other thing is that the fiscal consolidation, that deleveraging by the government, has added a lot more liquidity to our financial markets. So we have become an attractive proposition. I mean, it is good because we want Jamaica to be a destination for capital. The challenge we face, though, is that we have to ensure that this sort of environment redounds to the development of Jamaica. In other words, we firmly believe that our domestic money and capital markets must serve the development needs of the country. So we want to be able to attract capital to finance domestic investments. And that is what is very important for us at this time.
That's a good point. Julian or Charles, do either of you have anything to add to that?
I mean, I think Wayne covered it. I think we're definitely a lot more flexible in terms of the flow of capital than the two large English-speaking neighbors in the Caribbean who would possibly be competitors. And I also think our proximity to the U.S. market and the expertise that Jamaicans have gained from working in the U.S. market, a lot of that is here, and I think has helped the development of our own market here and has attracted capital from across the region. And I also think the stock exchange has been innovative itself in terms of we have a junior market. I'm hearing discussions about other markets. We are constantly bringing new products to the table, which make us attractive. And I think that is positive for the economy.
Okay, great. Charles, anything to add from the securities dealer standpoint?
Yeah, my only addition would be that I think that we have to be prepared to accept the principles of a market. If we talk about Jamaica being an open market, it means that we must be prepared to accept funds coming in and funds going out. It can't be a one-way flow. A one-way flow would be debt. You know, you can go and borrow money and...
So I suppose you weren't in support of the BOJ's restriction on dividends?
Well, I mean, I don't know that it might have been a prudential move, but what I'm saying is that...
It was a prudential move.
And that's not even where I'm going. What I'm really saying is that if we're going to accept that we're operating an open capital account, then we have to be prepared, and we want money to come in. We have to be prepared for money to go out too. I think that one of the things that we also have to, we have to have the confidence to accept these things. You know, 30 years ago, we lifted exchange controls, we nominally opened up and so on, and we had tremendous inflows of capital. We have $3 billion US in the reserves. The banks are holding hundreds of millions of dollars of US investments. You know, before that, we had minus 900 million in reserves and, you know, nothing in the banks. But we have to be prepared to allow the capital to both move in and out if we're really going to become a center, a capital, a financial center in the Caribbean. And we have to accept that there are going to be times when the market is going to run and people are going to pull their money and run. I mean, that's part of being a part of the global financial market. You know, if we want to control everything, we're not going to get the benefit of it.
We hear you, Charles. We hear you on the. We know your philosophy of market forces, and Dr. Robinson's point that the thin, small size of the market may pose some challenges to that. But I have one final question from actually a former IMF economist here, and he's saying. Low productivity has been an albatross for 40 to 50 years. The pandemic gave us a chance to focus on economic efficiency. What can be done to improve this into the recovery? Does anyone have an answer for that question?
I don't think there's any short-term solution, just being frank. And I think the fallout in education is going to make that challenge even bigger because I think you're going to have a set of young persons leaving high school with no capacity to function in the kind of society that we have. So the short answer is there is no short-term fix to the problem that has developed over 40 to 50 years. It requires a significant investment in our human resources so that we can attract beyond the low-level BPO, tourism and construction type jobs to higher value things. But you will not get the higher value investments if you don't have this higher value skills because you're competing with everywhere else in the world. I was at JAMPRO. When I was at JAMPRO, we had somebody who wanted 200 developers, software developers. We couldn't find that. We couldn't find 200. It's easy to find it if you go somewhere else in the world. So I'm just saying, we know what the problem is, but being in a position to train that level and retain is something that takes time. And there's no short-term fix to it.
Okay. Charles, your take on improving economic efficiency.
Right. Well, again, I mean, the question I would ask is, look, we have 300,000 people, they're barely literate, but they're willing to work. What are the occupations, the internationally competitive occupations that can absorb them? I think that's the question that we have to ask. We have a particular workforce. These are the characteristics. They may be far from ideal, but throughout the world, there are activities that people with those levels of education and skill can be absorbed in. China today is not China 30 years ago. 30 years ago, they were chumping out low-level, cheap manufactured goods. Now they're making Apple iPhones. We may be at the level now where we've got to chump out low-level, relatively low value-added stuff. But if that's what we can do, that's what we can do. I think we need to allow market forces to send the signals and absorb investment in the areas where we can be competitive. To put a plug on for the BOJ, I think one of the very good things that they've done, interest rates in Jamaica are relatively internationally competitive. You can invest at Jamaican dollar interest rates and be internationally competitive. That is key because we need to mobilize domestic capital to invest in productive enterprises that are export-oriented. So it's not just housing developments and hotels. We need to invest in export production as well.
Okay. And Dr. Robinson, I'll give you the last word.
Yeah, I mean, I can't, there's not much I could add to what I said before, but probably one thing I'll probably just stress. I mean, COVID has shown that we're in a new paradigm. And in this new paradigm, the economies and the societies that will strive and that will be efficient are the economies that are digitally capable. And therefore, Jamaica has to catch up. Jamaica has to move quickly up the curve in all spheres of our operations, all spheres of economic life. And this is one of the reasons why the central bank, we are pushing central bank digital currency. Because that's just one part of trying to move Jamaica along the digital highway.
Could you tell us just a bit, I mean, we could just take this opportunity for you to tell us a bit more. I know off air we were doing this, but tell us a bit more about the central bank's digital currency and its impact on, you know, the life of the average man, say, for instance.
Well, the average man will find it more convenient because it is cash, just like cash, but in a digital form. So instead of having a nanny in your wallet, you'll essentially have it on your phone. So it will be easy to use. There's convenience. It will be more secure. It's easy to acquire. So in terms of just being able to do business, if you want to get remittances, for example, you don't necessarily have to join a line. You can get it on your phone and you can spend it immediately. So it is about enabling the average person to buy and sell goods easier in a more secure and cost-efficient way.
That's brilliant. I think we all get a little bit more confidence and comfort knowing that our central bank is leading the way digitally and encouraging us to think along those lines. So I think that's a great note to end on. Gentlemen, thank you so very much for your time. I know you're all very, very busy. And thank you so much to our audience. And I'm sorry that we didn't get to every single person's questions, but definitely we appreciate your participation and attendance.
Anything on the score, Marianne?
Anything on the score? I've been waiting for it in the messages. I overpromised.
Okay.
2-1 to England, so we're all relieved, I guess. And there won't be any riots in England tonight, unfortunately.
You're going to have a lot of drunk people.
That's true, maybe a spike in COVID. But this program will re-air today on Nationwide News at 6 p.m. So tune in if you missed the first half because of the football. But thank you so much for your time, and good evening, everyone.